Nearly 1 in 5 suspicious transactions in the US now triggers an automatic bank restriction, sometimes within seconds. Imagine this. A 68-year-old retiree wakes up, reaches for his card to pay a simple bill, and it gets declined. No warning, no explanation, just silence. His money is still there, but completely out of reach. Now ask yourself, could this happen to you in 2026? With banks tightening fraud detection, AI monitoring every move, and new compliance rules rolling out, more accounts are being flagged than ever before, even by mistake. This isn't theory, it's happening right now, backed by financial reports and policy shifts. Stay with me, because what you're about to learn could protect everything you've worked for.
Number 1. The freeze reality. Imagine waking up one morning, reaching for your phone to check your balance, and everything looks normal. But the moment you try to use your card, declined. You try again, declined. You open your banking app and suddenly there's a message, your account has been restricted. This is what a bank account freeze really looks like. It doesn't mean your money is gone. It means your money is still there, but you can't touch it. No withdrawals, no transfers, sometimes not even bill payments. It's like your financial life is put on pause without your permission. And for many people, especially seniors, this moment brings instant confusion, followed by panic. Did I get hacked? Did someone steal my money? What's happening? The truth is, in most cases, it's not theft. It's the bank stepping in, often automatically, because something triggered their system. Maybe it was an unusual transaction, a login from a new device, or even something completely harmless that just looked suspicious. Now picture this. You have a medical bill due today, groceries to buy, or rent to pay, but your own money is locked behind a digital wall. Hours feel like days. Every minute becomes stressful. You start calling the bank, waiting on hold, trying to explain something you don't even fully understand yourself. This is the harsh reality of a freeze. It doesn't just block your money, it disrupts your entire routine, your peace of mind, and your sense of control. And the most unsettling part? It can happen without warning, even if you've done nothing wrong. So before we go deeper, take a second. Have you ever experienced something like this, even briefly? If this kind of real-world breakdown matters to you, make sure to like this video, subscribe to the channel, and stay with me, because what's coming next could help you avoid this situation completely.
Number 2. Why banks freeze accounts. Now here's the part most people don't fully understand. Banks don't randomly freeze accounts, they react to signals. And today, those signals are no longer checked by humans first. They're detected by automated systems running 24/7. Every time you swipe your card, transfer money, or even log in from a new device, that activity is quietly analyzed in the background. If something looks even slightly unusual, it can trigger a red flag. For example, a sudden large withdrawal, a transfer to a new account, or a login from a different city or country can instantly mark your account as suspicious. And the system doesn't stop to ask you questions first. It acts immediately. That's where the freeze begins. Behind this is something called anti-fraud and compliance monitoring, designed to protect both you and the bank from financial crime. Banks are legally required to follow strict regulations, especially around money laundering and identity theft. If they fail to act quickly, they can face heavy penalties. So instead of taking risks, they choose the safer route. Lock first, investigate later. And this is where the problem starts for everyday people. Because while the system is designed to catch criminals, it often catches normal behavior too. A simple situation like sending money to a family member for the first time, or traveling and using your card in a new location can look suspicious to an algorithm that doesn't understand your personal habits. What makes this even more complex is the rise of AI-based monitoring. These systems learn patterns over time, but they're not perfect. They rely on probabilities, not certainty. So even if there's a small chance something could be fraud, the system may still act. And once triggered, the process isn't always quick to reverse. Your account gets flagged, then reviewed, sometimes manually, sometimes through additional verification steps. Until that process is complete, your access stays restricted. So the key thing to understand is this: most account freezes are not personal, and they're not always accurate. They're the result of a system designed to minimize risk at all costs, even if that means temporarily disrupting your life.
Number 3. Why seniors are targeted. Now here's where things become even more concerning, because not all accounts are treated the same. Certain groups are more likely to trigger these systems, and seniors often fall right into that category. Not because they're doing anything wrong, but because their financial patterns, behaviors, and even lifestyle changes can appear unusual to automated systems. Many seniors don't make frequent digital transactions, so when there's a sudden change, like a larger withdrawal, a new online payment, or helping a family member with money, it can instantly stand out. To an algorithm, this looks like a deviation from the norm, and deviation often equals risk. At the same time, financial institutions are increasingly aware that seniors are one of the most targeted groups for scams and fraud. Reports consistently show that older adults lose billions each year to fraudulent schemes, phone scams, phishing emails, fake investment offers. Because of this, banks apply tighter monitoring to accounts that fit certain profiles. In theory, this is meant to protect, but in reality, it can sometimes backfire. A legitimate transaction, something completely harmless, can be flagged simply because it resembles known scam patterns. There's also a digital gap that plays a role here. Many seniors are less likely to use multiple devices, track real-time notifications, or quickly respond to verification requests. So when a bank sends an alert asking to confirm a transaction, there may be a delay. And in the world of automated systems, even a short delay can escalate the situation from a simple check to a full account restriction. The system assumes silence might mean risk, and it acts accordingly. What makes this even more challenging is the emotional impact. For someone who has spent decades building financial stability, suddenly losing access, even temporarily, can feel deeply unsettling. It's not just about money, it's about trust, independence, and control. And when systems are designed to act first and explain later, seniors often find themselves caught in a situation they never expected and don't fully understand.
Number 4. The false alarm trap. Now here's the part that surprises most people. A large number of account freezes aren't caused by fraud at all. They're triggered by false alarms. Systems designed to protect you can sometimes work too aggressively, flagging completely normal behavior as suspicious. And because these systems rely on patterns, not personal understanding, even small changes in your routine can set things off. Imagine this: you travel to visit family in another city, use your card at a new location, maybe withdraw a slightly larger amount than usual. To you, it's a normal day, but to the system, it looks like a sudden shift in behavior. Different location, different spending pattern, different timing. It checks multiple risk boxes at once. Or consider something as simple as logging into your account from a new phone or laptop. You upgraded your device, but the system sees an unfamiliar access point. That alone can trigger a verification process. Now combine that with a transaction shortly after, and suddenly your account activity looks inconsistent. Again, not because you did anything wrong, but because the system cannot fully connect the dots the way a human would. This is where the false alarm trap becomes frustrating. You're essentially being treated as a potential risk even when everything you're doing is legitimate. And once that alert is triggered, the system doesn't pause and ask for context. It moves forward with restriction. That's why many people feel blindsided. There's no warning, no gradual escalation, just immediate action. What makes it worse is how common this is becoming. As banks tighten security and rely more on automated monitoring, the margin for error increases. These systems are designed to prioritize safety over convenience, meaning it's better for them to block a safe transaction than to miss a fraudulent one. But that decision comes at a cost: your time, your access, and your peace of mind. So the real issue isn't just fraud, it's how easily normal life can be mistaken for something risky. And once you fall into that false alarm loop, getting out of it isn't always instant. Number 5. New 2026 banking changes. Now, step back for a moment, because this isn't just about isolated incidents. It's part of a much bigger shift happening in 2026. Banks are no longer operating the way they did even a few years ago. Behind the scenes, regulations have tightened, compliance requirements have expanded, and financial institutions are under more pressure than ever to detect and prevent suspicious activity instantly. This includes stricter Know Your Customer (KYC) rules and enhanced anti-money laundering checks, which require banks to constantly verify who you are, how you use your money, and whether your activity fits expected patterns. What's changed is the speed and sensitivity of these systems. In the past, unusual activity might trigger a manual review over a few days. Today, advanced monitoring tools, often powered by AI, scan transactions in real time. If something doesn't align, action is taken immediately. No waiting, no benefit of the doubt. And because penalties for banks have increased significantly in recent years, institutions are choosing to be extra cautious. From their perspective, it's safer to freeze first and investigate later than risk overlooking a potential issue. There's also a growing focus on digital identity verification. Banks are now cross-checking data more frequently. Your device, your location, your transaction history, all compared against your past behavior. Even small inconsistencies can trigger deeper checks. For example, if your usual pattern is local spending and suddenly there's an online transfer to a new recipient, the system may require additional verification before allowing it. Until that verification is complete, your access may be limited. Another important shift is how interconnected financial systems have become. Information is shared across institutions more efficiently, meaning alerts can escalate faster than before. A flagged activity in one area can influence how your account is treated elsewhere. All of this points to one reality. The banking environment in 2026 is more secure, but also more restrictive. The margin for what is considered normal has narrowed, and that means everyday users are more likely to experience interruptions, not because they've done something wrong, but because the system has evolved to prioritize caution above all else. Number 6. How long can it last? Now here's the question that hits hardest the moment your account gets frozen. How long is this going to last? And the uncomfortable truth is, it's not always predictable. For some people, the issue is resolved within a few hours after verifying a transaction or confirming their identity. But for many others, it can stretch into days, sometimes even weeks, depending on the situation. And during that time, your financial life doesn't pause. You're still expected to pay bills, buy essentials, and manage responsibilities, all while your access is restricted. The timeline largely depends on what triggered the freeze and how quickly the bank can complete its review. If it's a simple verification issue, like confirming a transaction, resolution might be quick. But if the system flags something more complex, such as a pattern that resembles fraud or a compliance concern, the process becomes slower. Your account may go through multiple layers of checks, sometimes involving manual review by bank staff. And here's where delays often happen. Banks handle thousands of these cases daily, and each one requires careful examination to avoid mistakes. Now, imagine being stuck in that waiting period. You call customer support, you're placed on hold, transferred between departments, asked to provide documents or answer security questions. Every step takes time. Meanwhile, your payments may start failing. Subscriptions get interrupted. Deadlines pass. The stress builds, not just because of the money, but because of the uncertainty. You don't know when it will end, and that lack of clarity makes the situation even more frustrating. There's also a productivity cost that many people overlook. Time spent dealing with a frozen account is time taken away from your daily life, your work, your routine, your peace of mind. Even after access is restored, the disruption can leave a lasting impact. So, while a freeze is often temporary, the effects can feel anything but temporary. It's not just about waiting, it's about managing everything around that waiting period without full control over your own finances.
Number 7. Hidden risks you don't expect. Now here's where the situation becomes even more dangerous, because the biggest damage often doesn't come from the freeze itself, but from the chain reaction it quietly triggers. At first, it seems like a temporary inconvenience. You think, okay, I'll just wait this out. But while you're waiting, your financial system is still moving, and that's where problems begin to stack up. Start with something simple. Auto payments. Your rent, utilities, insurance, subscriptions, they're all scheduled to go through automatically. But the moment your account is restricted, those payments start failing one by one. And most systems don't pause or show sympathy. They simply mark them as missed. Late fees begin to appear, services may get interrupted, and suddenly a short-term freeze starts creating long-term consequences. Then comes the credit impact. Many people don't realize that even a single missed payment can affect your credit score. If a bill linked to your frozen account doesn't go through on time, it can be reported as late. Over time, this can lower your credit rating, making it harder to access loans, better interest rates, or even basic financial services. And the frustrating part? None of this happened because of poor financial management. It happened because you temporarily lost access to your own money. There's also the emotional and logistical strain. Imagine needing to pay for medication, groceries, or an urgent expense and having no immediate access. You may be forced to borrow money, use alternative methods, or rely on others just to get through the day. This shifts your entire routine and adds unexpected pressure to situations that should have been simple. What makes these risks hidden is how quickly they escalate without warning. A freeze doesn't just stop your account, it disrupts everything connected to it. And by the time access is restored, you're not just unlocking your money, you're dealing with the aftermath of everything that happened while it was out of reach.
Number 8. Red flags before a freeze. Now here's something most people completely overlook. A bank account freeze rarely comes out of nowhere. In many cases, there are small warning signs, subtle signals that appear before the restriction actually happens. The problem is they're easy to ignore or misunderstand in the moment. One of the earliest red flags is a sudden transaction decline, even when you know you have enough balance. You try again, maybe on a different machine or website, and it still doesn't go through. At this stage, many people assume it's just a technical glitch, but in reality, the system may already be flagging your activity in the background. Another common sign is unexpected communication from your bank, a call, text, or email asking you to verify a recent transaction. It might seem routine, something you can deal with later, but delays here can matter. If the system doesn't get a confirmation quickly, it may escalate the situation automatically. What starts as a simple check can quickly turn into a full restriction. You might also notice unusual login alerts, notifications saying your account was accessed from a new device or location. Even if it was you, these alerts indicate that the system is tracking changes closely. Combine that with a transaction shortly after, and the risk level increases in the system's eyes. Sometimes the warning signs are even more subtle. Your banking app may temporarily limit certain actions, or you may be asked to re-enter details you've already provided before. These small interruptions often signal that your account is under closer review. The key issue is this: most people don't connect these dots. They treat each sign as an isolated inconvenience, not realizing they're part of a sequence leading up to a potential freeze. And by the time the restriction actually happens, it feels sudden, when in reality, the system has been building toward that decision step by step. Recognizing these early signals doesn't guarantee prevention, but it gives you something incredibly valuable: time to react before full access is taken away.
Number 9. How to protect yourself. Now here's the part that actually gives you control. Because while you can't stop banks from using these systems, you can reduce the chances of getting caught in them. And the difference often comes down to a few simple habits that most people never think about. First, consistency matters more than you realize. Banks build a behavioral pattern around your activity: where you spend, how often you transfer, what devices you use. The more consistent you are, the easier it is for the system to recognize your actions as normal. Sudden, unexplained changes are what usually trigger alerts. So if you're planning something out of the ordinary, like a large transfer, travel, or sending money to a new person, it's smart to inform your bank in advance. That one step can prevent your activity from being flagged as suspicious. Another key factor is keeping your contact information fully updated. If your bank tries to reach you for verification and fails, wrong number, inactive email, the system may escalate the issue automatically. Quick communication can often stop a minor alert from turning into a full freeze. This is where many people unknowingly make a mistake. They delay responses, thinking it's not urgent, when in reality the system is waiting for confirmation. Device consistency also plays a big role. Logging in from the same phone or computer regularly helps establish a trusted pattern. When you suddenly switch devices or locations, especially combined with financial activity, it increases your risk profile. That doesn't mean you should avoid change, but you should be aware of how it looks from the system's perspective. Then comes something even more practical. Always maintain a small financial buffer outside your primary account. This isn't about fear, it's about flexibility. If your main account is ever restricted, you still have access to essentials without disruption. In simple terms, protection isn't about avoiding the system, it's about working with it intelligently. Small, proactive steps can make a huge difference in keeping your access smooth and uninterrupted.
Number 10. The smart backup strategy. Now here's the strategy that separates people who panic from those who stay completely in control. Because no matter how careful you are, one truth remains. You cannot fully eliminate the risk of a bank account freeze, but you can eliminate its impact. And that comes down to one simple concept. Never depend on a single access point for your money. Think of your finances like a system, not just a single account. If everything, your income, savings, bill payments, and daily spending, is tied to one bank, then a single restriction can shut down your entire financial life instantly. That's the vulnerability most people don't realize until it's too late. A smarter approach is to divide access, not just money. For example, keep a secondary account at a different bank, specifically for emergencies or essential expenses. Even a small amount can act as a safety net when your primary account becomes temporarily unavailable. You can also spread your payment methods. Instead of relying on one debit card, have an alternative, another account, a credit card, or a digital wallet that isn't directly linked to the same system. This way, if one channel gets restricted, you still have another way to function without disruption. It's not about complexity, it's about flexibility. Another overlooked strategy is separating your responsibilities. Use one account for fixed payments like rent and utilities, and another for daily spending. This reduces the chance of everything being affected at once. If one account is flagged, the other can still operate normally. What makes this approach powerful is the psychological shift. You're no longer reacting to a freeze, you're prepared for it. Your routine continues, your essentials are covered, and your stress stays controlled. In the end, it's not about expecting something to go wrong. It's about building a system where even if it does, your life doesn't stop with it. And now I want to hear from you. What would you do if your bank locked you out tomorrow morning? Drop your answer below, because your experience might help someone else avoid a real crisis. If this opened your eyes even a little, don't just scroll away. Tap like so more people see this, subscribe to stay one step ahead in 2026, and share this with someone who still thinks it can't happen to me.